And for the broader market, joining us now is Tom Lee, Fundstrat Head of Research and CIO and a CNBC contributor. And Tom, it's great to have you back on.
Great to see you.
So let's start right there, because we did have a bit of a bounce back here in Bitcoin and really across the crypto landscape today. But yesterday, as Katie Stockton over at Fairlead pointed out, Bitcoin broke below its 200-day moving average. I know she's watching some technicals there pretty closely. How about you?
Yeah, I mean, I think it makes sense to watch the technicals for Bitcoin. As you know, Bitcoin is very sensitive to market liquidity and also perceptions about risk appetite and risk premia. And, over the past couple of weeks, I think there have been headwinds building, right? From the government shutdown to a hawkish Fed cut that was done last month and uncertainty about December. And as you know, with the shutdown, Treasury liquidity, the Treasury general account's actually been building cash. So I think all of these created a cascade of problems that put pressure on crypto. But hopefully, as you know, headwinds become tailwinds when you can resolve these things.
Yeah, I want to hone in for a second, because I'm not sure we've been talking enough about it, but that funding stress we've seen in SOFR, I know there was data that was put out on Monday showing just a huge drop in that secured overnight financing rate on Halloween from the day before. Should we be paying closer attention to that and what that's meant in terms of the liquidity picture across asset classes?
Well, people definitely pay attention, Morgan, because one, as you know, that can often be an early sign of stress, but it also takes place when there's window dressing. So and banks are doing window dressing at the end of months. So I am kind of watching it, but I think those funding stresses have eased. And of course, it hasn't spilled over and reflected in what should be building stress in either credit markets or in bank equities. And so I would just say that it's an anomaly, and it may be due to the shutdown. But yeah, it's worth watching.
Okay. Just the fact that we have had this deleveraging event, if you will, in Bitcoin. I mean, what do you watch to know that that's washed out? And I guess perhaps just as importantly, has this been playing out the way it has previously in the market?
Yeah, in some ways. I mean, I think we have to go back to two different episodes. 2022 when FTX collapsed, and then in 2020 when we had the COVID shock. And in both cases, those were really widespread deleveraging events in crypto, because as you know, in crypto, there is typically a lot of leverage. The October 10th deleveraging was the biggest in history. And that means there are still ripple effects being felt even 2 weeks later. There has been a DeFi protocol, Streamer, that actually reported a pretty sizable loss, and that created further ripple effects. And that's what happened yesterday, along with this thing called the balancer hack. So I'd say it's probably still a couple more weeks. The good news is there aren't a lot of bodies floating to the surface, so it doesn't feel systematic, but it's going to take some time for confidence to come back. And I think that's why crypto took it so hard in the last couple of weeks.
Got it. So what's the read-through to stocks, specifically the QQQ or the NASDAQ 100? We know there's always been this very strong, or in more recent years, a strong correlation between the two.
Yeah, and the linkages are growing because, as you know, like market makers actually trade both products. And I think in general, people get nervous because part of it is stocks have been up 6 months in a row. And we have to keep in mind that in October, we had the wobble in the first half before markets found their footing. I wouldn't be surprised if people are just pausing here and saying, look, we still have the shutdown. We've had 6 months in a row, stocks are up. Markets are overbought, and they get a little nervous. But let's say that just means a wobble in the first half of November. Since 1928, okay, 100 years of data, when markets have been up 6 months in a row, 5 or 6 times you build on those gains with an average gain of 3%. And in 1936, the market was flat. I'm sorry, 1942. So in other words, you either have a flat November or actually strong. It's actually a good sign we've been up for 6 months in a row.
Okay. Given all the focus there's been on stretched valuations, particularly tied to the AI trade, do you anticipate here then into the final weeks of the year that we're going to actually start to see this broaden out a bit?
Yeah, it makes sense. I think, we are doing more Zooms with institutional investors where they're talking about not 2026. So they're trying to position. And I mean, part of me would say I think the Mag 7 and the AI stocks are still reasonably valued because they're growing at more than double-digit growth rates, and even NVIDIA, the biggest name and most important stocks, only at 29 times forward earnings. So they're not demanding, but there are plenty of stocks that have underperformed for 3 years, where their underperformance is so severe, you haven't seen it in 50 years. And so I think there is going to be some folks looking to buy mean reverting ideas, but I'd still say I like the AI. I think there's a lot of visibility, and I think companies are starting to see payoffs. So it still makes sense to stick with it.
Okay. Tom Lee, thank you.
Thank you.